In this episode, we're talking about how to protect your income through a market crash.
Well, Grant, markets have been on a tear since 2008.
Yeah, pretty much.
And with the recent, talks in trade wars, interest rates, we've seen some volatility in the markets in the short term. The markets are hitting all-time highs again.
Mm-hmm.
People are, especially people who are approaching retirement, are a little worried about protecting their income during a market crash.
Yeah.
What would you say to these individuals?
Well, I would say that there are strategies that you need to implement in order to protect your portfolio and protect where your income is coming from. A lot of people think that when it comes to investing, it's all about predicting like the right investment at the right time and timing it out. And really, as we know, that's a losing strategy long term. You might get it right once or twice, and that's really just luck. But really, the only surefire way to make sure that you can protect your portfolio and your income is by using planning strategies, income protection strategies. One of which that we use fairly regularly with clients is called a cash wedge strategy. And without getting too technical behind it, the essence is you take 3 years or at least 3 years worth of a client's income. So for example, they're taking $20,000 out per year. We're going to take 20 times 3, $60,000 approximately, and we're going to carve that out of their regular investments, which would be stocks, bonds, real estate, infrastructure, etc. We're going to carve that out and put it into ultra safe investments. So things that are essentially, either guaranteed or very close to guaranteed in value, so that the next time a market crash hits, and really that could be any time after the nice long run we've been on, if the market crashes, those investments, those ultra safe investments we've carved out, are either going to be very flat, as in haven't lost anything, or they're probably going to even be positive, and is the nature of those types of investments. The real benefit of that is that we're not selling off of any of the other investments that have gone down in value. So that's essentially how you carve it out and you protect yourself, and then at that point you don't worry about what market fluctuations are going on.
Huge wealth destroyer is buying investments high and selling them low, like you're talking about in the market downturn here.
Yeah.
So what you're saying is with your portfolios, it's protecting your portfolio is more about planning in advance than it is trying to predict the best investments over the course of a year or several years.
150%, frankly. Trying to choose the right investment through a market crash is an absolutely futile exercise. Nobody knows what's going on. I mean, all you need to do is look at the most famous investors of all time. You look at the Warren Buffetts, you can look at endowment funds. The fact of the matter is, with all the resources they have available to them, why aren't they trying to predict what's going to happen in the market crash? Why aren't they doing that? The reality is you can't. So they don't try. They're not going to try. Why would we? We're not going to try, and you shouldn't try either. The fact of the matter is the only guarantee you have is a good plan. Putting a good income protection strategy like a cash wedge is as near a guarantee as you can get, basically, when it comes to investing and protecting your income. So you put a planning strategy in place that gives you the highest degree of confidence that you're going to be successful. The people that didn't do that through 2008, and I don't blame the investors, I blame the advisors. The people that didn't do that through 2008, a lot of people ended up either remortgaging their houses or going back to work who were retired.
Which we want to avoid at all costs.
Absolutely. If you want to avoid going back to work or taking on debt that you don't want or selling your home before you really want to, the best thing you can do is implement strategies like the cash wedge I'm talking about, and that will ensure that you're able to continue on with your life, continue on with your lifestyle. And frankly, if you didn't look at your statements throughout the 2008-2009 period, you never even knew the market crash happened, because the portfolios would have recovered as long as you give them the time to recover.
Grant, you talked a little bit about the types of investments that you're using to create your cash wedge. Why don't you tell us a little bit in more detail what those are?
Yeah, so as I mentioned, they have to be ultra conservative or ultra safe investments. And so what I really mean by that is traditionally, with interest rates a little bit higher than what they've been over the last few years, we would have used things like GICs. So for example, if in the first year of the cash wedge, we didn't want to lock up any money, we probably would have used something like high interest savings accounts. Not making a lot of money on it, but you're not losing anything, and you're guaranteed to earn a little bit. So high interest savings for year one. Year two, we would have looked at a 1-year GIC, because by the time year one is done, the second wedge is maturing basically. And so that money
if the
becomes
markets
available.
haven't recovered.
Exactly. So we've got that available to us. So a guaranteed investment, again, you're not going to get rich off of it, but it's guaranteed and it's going to grow.
It's going to give you that income.
Yeah. Likewise, on the third wedge, we'd use a 2-year GIC for the exact same reasons. So those are traditionally the types of investments we would have used in the past. We still use some of those, either those types of things or ultra short-term bonds are also good because they're essentially, I mean, you could trade them before they mature, and then you might have some market fluctuations, but the market fluctuations are going to be very little on that. And so if you go through a 2008 type of event, most of the short-term bonds actually still ended up positive throughout that period of time. So those are the types of investments we're looking at. But really, short-term in nature, guaranteed or either very low volatility investments. So you're not going to see a lot of price fluctuation on them.
Perfect. Well, with that, we'll close off the episode. If you're wondering whether or not a cash wedge is something that should be implemented in your portfolio, feel free to get in touch with us. We'd be happy to sit down and offer a second opinion to you on your plans and whatnot. Or just if you had questions with regards to anything around your investments and your financial planning, again, reach out.
I would say if this planning hasn't been done, or if you're concerned that it hasn't been done with your current advisors, give us a shout. We'd be happy to talk with you about it. Maybe it's done and you just need to be reminded about it. But like I said, the worst thing in the world would be somebody has to go back to work through the next market crash. So feel free to reach out. Ready,
Aim,
fire.